Good evening, everyone. On behalf of Axis Bank, I welcome you to the 18th edition of Treasury Market Talks. Axis Bank has been instrumental in serving a wide spectrum of its customers through innovative financial solutions and products, covering large and mid corporates, SMEs, agriculture, and retail businesses. The bank has leveraged the power of technology to provide uninterrupted, best in class service benefiting its wide customer base. We aim to equip clients with high quality input around emerging issues, and to this end, have emerged as a well respected thought leader within the banking industry. As part of its thought leadership initiatives, Axis Bank has been organizing Treasury Market Talks, a talk series hosted by its corporate banking team on diverse topics like central banking, fiscal policy, geopolitics, macroeconomics, and financial markets. We have been honored by the presence of many eminent speakers as part of this initiative, notably Michael Pettis of Peking University, Joseph Stiglitz of Columbia University and a Nobel Prize winner, Pramit Pal Chaudhary of the Eurasia Group, Professor Otmar Ising, founding ECB Chief Economist, and Baroness Ashton, who was the former EU Foreign Policy Chief. Uh, just to name a few. The talk series has been received very well by all stakeholders with great enthusiasm and participation from leaders in the corporate world and other diverse fields. Uh, Today, we are in conversation with Bilal Hafeez on global macro and markets. Bilal is the founder and CEO of Macro Hive. Uh, uh, Macro Hive, and before that, he worked as global strategy FX head in Nomura, and actually, he held many global strategy head roles in Nomura. But before which he was in Deutsche Bank, uh, Asia Research, where he won, or where he was ranked number one by Euro Money for 10 years. Bilal is a noted expert in global markets and will be happy to answer your questions after the call. Speaking with Bilal is Neeraj Gambhir, Group Executive, Treasury Markets and Wholesale Banking Products at Axis Bank. Some housekeeping announcements before we begin. Participation in the webinar is by invitation only. Axis Bank reserves the right to block access to any person to whom an invitation has not been sent. Unauthorized dissemination of the contents of this webinar is strictly prohibited, and prior explicit permission of Axis Bank is imperative. As a reminder, all participant viewing panels will be in the view only mode. Participants who wish to ask questions may post them on the question box on the screen. Please note that this conference is being recorded and may involve the presence of the press or media. On behalf of Axis Bank, I once again welcome all our customers to this event. I now hand over the forum to Neeraj. Thank you and over to you.
Thank you, Tane. Bilal, it's fantastic to have you with us. I'm a huge fan of your Macro Hive platform that you have created of independent researchers. I do follow your podcast quite regularly. And we have you today on the other side of the table. Uh, I know you're a very regular podcaster, and your podcasts are amazing to listen to. So, we are in a very interesting place as far as the global economy is concerned. We've had one of the most aggressive rate hiking cycles ever, uh, a very synchronized rate hiking cycle across the world. But as we are entering the fag end of that cycle, and probably we are in many places, it's a pause. There is a worry that we are probably going to stay around at these levels, what is being called as higher for longer. At the same time, if you look around, the expected impact of such a steep rate hiking cycle on the economic performance has not played out really that much, right? US still continues to be fairly resilient as far as the growth is concerned. Um, I mean, 6 months ago, we were all forecasting, or the markets were forecasting, a start of a rate cutting cycle starting September 23. And we are in September 23, and there's no visibility on when the rate cuts will happen. European growth, which was supposed to fall off the cliff immediately after the Ukraine war, has again been reasonably resilient. There are some cracks now that are starting to appear. China, which was supposed to be the beacon of growth post-pandemic, has really not played out the way it should have. Japan has also surprised by its stubbornness to continue with the loose monetary policy, despite stronger than expected inflation. So, just help us with your broad brush macro sweep to kick off this discussion, and then we'll probably dig deeper into a few of these aspects.
Yeah, absolutely. And once again, it's a great pleasure to speak to you, Neeraj, and to work with Axis Bank, which is one of the sort of top banks that I like to speak to. Yeah, so in terms of doing the global sweep, I would say that what's interesting is that we have three camps in the world. We have the US, where growth is actually quite strong and everything is going relatively well. So households feel good. Their wages are going up. The economy in general is doing very well. Then you have Europe, which has more of a stagflation flavor. So there you have inflation that's sticky and high, but growth that's weakening. So it's a stagflation mix. The US has growth. Europe has stagflation. China has stagnation, i.e., it has low inflation and low growth. And then Japan is doing its own thing as usual, where Japan in some ways is doing really well. Its growth has been quite strong. Its profit margins are incredibly high also in the corporate sector, which has been one of the big surprises. And of course, inflation is high as well. So we have these 3 or 4 camps around the world. And the one thing I would say is that on the US side, at least, what's really helped to strengthen the US economy are two things. Number one, the nature of the US mortgage market is such that people have 30-year mortgages in the US. So even if the Fed raises rates, as it has done over the past year or two, people still have their 2% mortgages that they've locked in a number of years ago. So unlike Europe and other countries, where your mortgage rate is a 2-year mortgage rate, where it moves with the policy rate, the US doesn't have that. So that's one reason why the US households are doing much better than anywhere else in the world. The other is that the US has done a lot of fiscal stimulus. They've got the infrastructure bill, the CHIPS Act, Inflation Reduction Act. There's a lot of government money that's just pumping through the economy that's really helping the economy doing well. And that's one reason why the US economy has ended up doing much better than many people have thought.
And that's interesting because, a lot of us were actually forecasting a very steep recession. If not a very steep recession, at least a recession to have started by now. Your team, and I think it was Dominic is a part of your research team, which was forecasting a 8% Fed funds rate some time ago. And that was a kind of out of the consensus, a bit outrageous, I would say, call to say that Fed funds is going to go to 8% and was a bit scary also, to be honest. Do you guys, we're close to 6 now. So in some senses, directionally, she has been quite right. Do you guys still believe that there is a lot more to go as far as Fed fund rates is concerned?
No, you're right. Dominique, who's the economist in our team, she's very accomplished. And when she first came up with her 8% view, I thought she was crazy. But she, directionally, as you say, she's been right. And we still think that the Fed could raise rates to 8%. It may not be 8, it may be 7.5, but we are going to see more hikes. So and the reason for that really comes down to 2 things. Number one is that we think that inflation will be stickier than everybody thinks. Now, the consensus in the market is that within a year or so, inflation in the US will be back to 2%. And our view is that no, it won't. Inflation will be higher. It will be around 3.5%. And one reason for that is that if you look at the experience of emerging market countries, not least like countries like India, but also the US in the 70s, once inflation picks up a lot, like it has in the US a year or two ago, it's very hard to bring it down back towards target levels. And I think that people in the West are so used to low inflation that it's hard for them to accept that they're in a higher inflation regime. So I think number one is that once inflation has started, it's hard to control it. And then second is the strength in the US economy, which is doing really, really well. The labor market still is strong. Also, household income is picking up in real terms, so households feel good. Another thing that's very interesting is that factories are opening up in the US. So there's a lot of construction of factories in the US, and all of this will keep the US growing around trend or maybe above trend for the next 12 to 14 months. And that will then force the Fed to end up having to raise rates further towards 7-8%, which is our forecast.
And does that also change your outlook on where the rates will eventually settle? I think there's a lot of debate which is going around to say that the neutral rate or R star, the celebrated R star conversation has probably moved from 0 to maybe 2 or 3. Very hard to figure out empirically where these things will settle. But what's your view? Do you think that persistently now inflation is higher and hence the rates will need to be higher?
Yeah, I mean, I think that we're in a new regime, and in some ways, what I'm saying is that the environment that we were in after the global financial crisis up until COVID was a very unusual period. In some ways, it's a one-off, where inflation was very low, interest rates were very low, and that's the exception rather than the rule. So for me, the neutral rate in the US will be something like 4% or maybe 4.5%. So that's really the rate that's kind of the neutral long-term rate for the US. And what that tells you is that in real terms then, assuming we do eventually get to 2%, then the real interest rate is around 2%, which it was in the 1990s. That's where it was also. So the average interest rate that the Fed had from, in the 1990s up until 2007, up until the GFC was around 4.5%. So my sense is that's around 4 to 4.5% is the neutral rate for the US.
And what's also striking this time around in the cycle is that the long bond yields in US have actually started reacting towards probably the fag end of the cycle, right? Now you may say that it is not really the fag end and you are expecting it to go a lot more, but broader market sense is that we are done, right? I mean, if you look at the Fed funds curve, for example, it says that we are done. But the US long bond yields have started to move up. And part of the reason possibly is that the full impact of US fiscal deficit and the fact that there is a lot of fiscal loosening that is happening and the government needs to borrow a lot more from the market is starting to play itself out. What's your take on that? Do you think that fisc is a real problem in US?
It's a great point, and I do think it is an issue for the US. When you issue so much debt, there's a price you have to pay. And what we've seen noticeably over the last 2 to 3 months is that whenever you have bond auctions in the US, the yields start to spike higher at the auctions. So that generally tells you that investors are saying, hang on, we can't accept all of these bonds, at the current price. We need a better price. And so yields have to spike higher. And that's what's really driving long-term interest rates, 10-year interest rates higher than before. So this is probably the first time since COVID that we're seeing concerns about the debt, the amount of issuance starting to feed into the US curve. So I think that's going to continue, and that's one big factor. The other factor is what we talked about earlier, which is that US growth has been stronger. So if you look at what part of the US 10 years going up, its real interest rates are going up a lot, which tells you that the market is saying that the long-term US neutral rate or long-term US growth is better than we thought before. So it's a combination of better than expected growth for the long run, plus also more debt issuance that is making yields go up. And I think this will continue.
Bilal, what do you think is going to be impact of the fact that US 10-year bond yields are going to probably be around 4.5 to 5%? I mean, if I look at closer home to India, we are at 7.5% in long bond yields. So it's 300 basis points. A lot of people say that from a historical standpoint, 300 basis points is a very narrow interest rate differential. We know in many parts of the world, the rates differential between US and those economies are pretty low. How do you think this plays out? If the bond
it's a great question. And I think right now we're entering a phase where investors are paying attention to the relative interest rates. And my sense is that the closer we get towards 5, already we're above 4.5%. Number one, this will start to have an impact on risk markets in general. So equities will start to weaken because interest rates are going up, especially tech stocks, which we're already seeing. But more than that, what will happen is that global investors will look at the interest rates you can get in the US and say, hang on, emerging markets, countries like India, their yields aren't high enough. So I think we're in a very challenging environment now for emerging markets. Emerging markets have actually done very well, countries like India in the last year and a half. But I think now that US rates are 4.5, 5, that changes a lot of things. So I think this is a very challenging environment for bonds in EM countries, including India. And I think in the next 3 months, I think will be a big test for those markets. I think the general pressure will be for yields in India to go up because of this pressure from the US side. It's very hard to escape the fact that US yields are going up.
I'll come back to this point a little later, Bilal, in the context of our index inclusion. But let me just touch upon another point, which I think is starting to capture markets' attention. And it seems to be happening with a lot more regular frequency now, the US government shutdown, right? Every 6 months or 12 months, we keep on coming back to the story of, oh, US government is going to shut down because there is a debt ceiling or something to that effect. Help us understand, why does this happen again and again, right? And does this time, is this time any different from the last time? I mean, every time in the past we've seen, some deal being announced between the two parties and, it's back to the normal. But is this time any different?
No, it's a great point. I mean, historically, what happened every year around the fiscal year end, which is the government's fiscal year, which is end of September to September. What happens is Congress, both the House and the Senate in the US, have to agree the budget for the following year. So that they do something, they pass what's called the appropriations bill, so that they allocate all the money to spending for the next 12 months. In the past, that was done very easily. Everybody would just vote it through and it would get done. But because US politics is so polarized, every year now they have a fight over this. And so the latest fight is that the House in the US is controlled by the Republicans. The House Speaker is McCarthy, who has a weak position because he's dealing with very right-wing Republican faction and the more moderate Republicans. The right-wing faction essentially wants to cut spending on Ukraine, and they want to cut government spending. So what they're doing is they're saying, unless this happens, we're not going to approve the budget for the next 12 months. So what they're using is this annual process that historically was, just an automatic process. They're using it to start to affect policy. And so this is what's happening now. So the Republicans are demanding some of these changes. The Democrats are saying no. So by the end of September, if there's no continuing resolution passed, then we'll have a government shutdown. So this is the scenario we're in at the moment.
And we're just about 2 days away from that, right? So we'll really know about 2 days' time will the government continue to function. And if it does shut down this time, what is going to be the impact? Does this materially impact US creditworthiness, for example? Do we expect another downgrade? Do we expect some kind of a blow up in the US bond market? I mean, how do you think it will play out in case it doesn't go as expected?
Yeah. There's a couple of different things. One thing that sometimes does happen is they sometimes come up with like a 10-day stopgap measure. So what could happen is in the next 2 days, they could say, we have an agreement for 10 days to keep the government funded. Then they negotiate, then they have the shutdown. So there's a risk that could be delayed. But leaving that aside, if we do have a government shutdown, normally, interestingly, it doesn't have a big impact. From a market's perspective, the market views it as a temporary thing. So the market looks through the shutdown. And then from an economic perspective, what happens is the government stops spending for 2-3 weeks. But then, so the economic data weakens, but then they start to spend again when the government shutdown ends. The main risk is that if the shutdown lasts more than, say, 10 days, if it lasts for 1 month or 2 months, which has happened in the past, that's when it starts to have more of a negative impact, especially on the economic side, where suddenly economic data will be much, much weaker. Now, most people think this will be a short shutdown. There'll be enough kind of consensus, agreed. But, if it's a short shutdown, it doesn't have a big impact. If it's a longer shutdown, then it could have an impact.
Yeah, I'm hoping that this time around will be pretty much like what happened last time. A deal will be arrived and we will avoid any kind of impact on the markets. But this brings back to the point of US politics, right? I mean, it is becoming more and more important now as we are nearing the next sort of presidential elections. Clearly, this back between Trump and Biden. And there is some possibility that Trump might return, although I don't know how much is the probability around it. What's your take on US politics? What happens if, for example, Trump comes back into the power as president and notwithstanding his legal troubles, but does this materially change, for example, the trajectory for the US fiscal or the US rates market? Considering that he might be a little bit more hard-nosed about the U.S. economic policy or the trade policy. So, does the change of power mean a material change for the markets?
Yeah, and it's a great question. I mean, first of all, I would say that we're in a very unusual situation where we have a former president running again after they've lost an election. Normally that doesn't happen, number one. Number two, it's very unusual for candidate to be to possibly be going to jail. So he has both federal and state charges against him, and that's very, very unusual. What makes it even more complicated for the Republicans is that if you look at polling amongst Republicans, he's very, very popular. Other candidates like DeSantis or Vivek Ramaswamy or Nikki Haley, they aren't as popular. Rob DeSantis, his popularity is actually going down. So at this stage, it looks like Trump will win the nomination. So we'll have this unusual situation where you have Trump campaigning while at the same time going to court. So this is a very, very unusual situation, and I think it'll be will make for a very kind of volatile period running into the election. Now, if Trump was to win the election, I think there's two consequences of this. Number one, I think that we would start to see an impact on the geopolitical side. I think Trump would become, again, more aggressive on China than Biden is. Although Biden is actually very aggressive as well, but he does it in a more quiet way. So nevertheless, there'll be some more kind of volatility in terms of relations with China. But the bigger one could actually be Ukraine, where Trump may actually say, look, we're not going to back Ukraine anymore, and push it onto the Europeans. And that could really disrupt the energy markets if that was to happen. So that's the real wild card of all of this. On the fiscal side, whether it's Trump or not, what matters on the fiscal side is who wins the House and the Senate. Is it whoever wins, do they get a clean sweep? At this stage, it looks unlikely. So even if Biden wins or Trump wins, the fiscal picture may not change that much, because it's not clear whether if Trump wins that he captures the Senate and the House all at the same time.
So there was this talk about, Trump. I don't know if it was a part of Trump's manifesto or his agenda that he talked about, that there will be a 10% import tax, right, to protect the U.S. Industry and to encourage local production. Policies such as this, they feel like they'll be quite inflationary, right? I mean, if U.S. makes the imports, if Trump makes the imports into US expensive, clearly US inflation is not going to settle down lower. So it does feel like that this political outcome may also have some bearing on where ultimately US inflation settles. Do you think that's a real risk?
I do think that that's a real risk. And I think in general, the more volatility and uncertainty you have around even the possibility of this tax forces US companies to bring things onshore as much as possible, because companies have to plan for the long run. And if there's a chance that there may be this tax or not, they have to bring things onshore. And that is inflationary overall. The one kind of quirk is that, of course, there is the NAFTA Part 2 agreement between Mexico, Canada, and the US, which would not be subject to that 10% tax. So what you could find is that Mexico ends up doing very well in such a scenario. So there are some kind of anomalies like that. But in general, I think we are in an environment where the US is trying to bring as much, onshore as possible.
Let me just shift the gears a little bit, focus a little bit about Europe. I think what we're beginning to see, at least in the continental Europe, is a slowdown. Germany seems to be sort of in the midst of this. Maybe it's spreading across. And Europe also seems to be towards the end of its rate hiking cycle. So do you think that we are reaching a stage where potentially there is a deeper correction of economic activity in Europe, and hence ECB is probably the first central bank to start thinking about aggressive rate cuts? And in that sense, the tables turn. Instead of Fed going first, it could be ECB going first. And that seems to be showing up in Euro's price as well, right? So what's your take on that?
Yeah, I mean, I do think that's a real possibility. And I think that Europe, we kind of underestimate the impact of the war in Ukraine. That really has disrupted the European supply chain. It reminds us how sensitive euro area is to energy shocks. So Europe has had to rebuild its energy infrastructure, move away from, gas from Russia towards LNG imported from the US and Qatar. So it's had to kind of rebuild its energy infrastructure. And also at the same time, Germany is dealing with a structural decline in its auto sector, where Germany essentially, its auto sector was long, the internal combustion engine, ICE, the old cars, whereas the rest of the world's moving to electric, and Germany is really struggling in that change. So, for example, if you look at car production, US car production's really picked up a lot this year, same in Japan, same in China, and Germany hasn't picked up that much. And that's partly to do with the energy issue. It's partly also to do with the engine issue, that they aren't moving to electric cars. So I do think that Europe has a real growth problem. They also have sticky inflation, which makes it quite hard for the ECB to necessarily cut rates. But I do think they are more likely to be the first to cut rates, out of all the major central banks. I'd also say that they did have some of their QE measures. They had something called TLTROs, where they essentially provided cheap financing to banks who would then extend that lending to corporates. They've withdrawn a lot of that. So there's been quite a lot of tightening that's come through withdrawal of that program, in addition to the rate hikes. And so they could say, actually, we're tightening on that side, so it's okay for us to cut policy rates.
What about China? I mean, I think it's been a big surprise story, right, over the last 12 months. The kind of rebound that was expected in Chinese growth didn't really materialize. Now we are hearing about problems which could potentially be long-term structural problems. I mean, look at the real estate industry there, how that's kind of unraveling. Look at the issues around consumption. Also, the story around the fact that a large proportion, I think the number was somewhere close to 20% of Chinese youth is currently unemployed, and there is a challenge there. So in that context, how do you see China playing out? I mean, there are some people who say that it is probably beginning of Japanification of China. I mean, the kind of problems that kind of, and having worked for a Japanese firm, I'm sure you know this very well. It's the kind of problems that Japan started to see at the beginning of maybe late 90s. Aging population, a lot of leverage in the system, banking system kind of trying to take care of these problems of debt, and Chinese policymakers don't seem to be in a tearing hurry to provide stimulus to the economy. I mean, what's going on there in your mind?
Yeah, no, it's a great set of questions there. The first thing I would say is that since COVID, if you look at the composition of Chinese growth, they've really had two sources of growth. One has been exports. So China's generated a lot of growth from exporting. Initially, it was COVID equipment, and more recently, it's cars and things like that. So they've relied a lot on foreign demand to help the economy. And then the other source of demand has been the reopening that we saw earlier this year, where they had the lockdowns, they reopened, so people started to go to restaurants again. Outside of that, there's been no major sources of growth. So that's the first observation I'd make, that there aren't really much levers of growth within China. The second thing is, from a policy perspective, traditionally what China has done is that they've used the property cycle to boost the economy. So, for example, after the global financial crisis, what China did was that they pumped a whole load of money into building roads, building apartment blocks, and that really stimulated the economy. Today, they can't do that. And the reason they can't do that is they've got too many roads and too many apartment blocks already, and they have too much debt. So there's a debt problem in the property sector. So they've kind of reached the limit on what they can do on that side. And that's why they're really struggling to generate growth right now, because they've run out of tools to generate growth. And so they're having to cut rates. They're having to ease up restrictions on the housing sector. They're trying to do all of these sorts of things, but it's very hard to do that when you have this big property problem. And if you step back, what is the fundamental problem here? The fundamental problem is that China has a lot of bad debt that isn't being restructured. And so just like Japan in the 80s, in the early 90s, it had a lot of bad debt, and Japan in the 90s didn't restructure that debt. They kept that debt on the balance sheets of companies and banks and hoping that somehow they could grow their way out of the problem. The problem there is that every time you get some new credit into the system, it goes to servicing the old bad debt, and you end up with no growth. And China's in the same situation today. They really have to make a decision around, do they restructure the bad debt, which is painful in the short term, but then it allows new credit to go to productive parts of the economy, or do they just continue to keep rolling this bad debt over and over again? So far they're doing the bad option. They're rolling over bad debt. They're not willing to recognize the problem, and so this means they're really going to struggle to generate growth going forward. And so from a growth perspective, it just means that we are in this steady declining growth over time. There are some pockets of strength. So electric cars is doing well, and the chip sector is doing well. But outside of that, there's general weakness. And so this is a big problem for China. And I think this is something that at some point, presumably there will be a breaking point where President Xi will have to do something bigger. But for now, there's no real signs of any major, radical shift in policy.
And, China was the engine of global growth for the last 20, 25 years. It was also exporting a lot of disinflation, right? The cheaper manufacturing in China was really a large contributor to the fact that global prices were well capped, right? Despite such a large monetary stimulus. Does that equation change? I mean, there are two ways to look at it. One is to say that, look, China is going to be into this problem and deflation is going to show up in China. And that will basically force China to keep exporting at lower and lower prices, and that could eventually mean that the global inflation comes down again. Or the second is to say that China has so much of its own domestic problems that probably that export your way out of it at a cheaper price may not necessarily work, because if they're not giving the stimulus, then it's hard to keep that thing going. So how do you think this plays out from a impact on global inflation standpoint?
Yeah. Again, a great question. I mean, my kind of sense overall is that at the margin, it is slightly disinflationary, but I would say that China's place in the global supply chain has changed, where other countries now have moved into the lower price levels that China once held. So Vietnam, Bangladesh, India obviously is trying it as well, and Malaysia as well. So there's other countries now that are kind of the drivers of pushing prices lower. I would say, though, that if you look at inflation in China, it's very, very low. And so when they are exporting deflation to the rest of the world. But I think that their share of the important types of exports that drive global inflation is less than before. And then in terms of whether China can rely on exports, it'll be very difficult for them to rely on exports alone, mainly because the size of the Chinese economy is so large that exports won't be enough to stimulate the overall economy. And in fact, if you look at the evolution of the Chinese economy, in the 1990s and 2000s, they relied on exports to bring the economy up. Then in the 2010s, it moved away from exports toward domestic infrastructure. That's what drove Chinese growth. So when you reach a certain size of economy, you basically need the domestic side to pick up, and exports just won't be enough to help them.
So how do we bring all of this together? And before I come back to India, how do you bring all of this together into your views around what happens to the rates in the main, economies? What happens to the FX, for example? What happens to the dollar euro, dollar China, dollar yen? How do you see all of these things kind of play out over the next, say, 6 to 12 months?
Yeah, I mean, I think one thing is that I think that US yields, like say 10 yields, will go higher. I think we could go up towards 5% or 6%. So that will put a lot of pressure on all bond yields around the world. I do think US yields will move up faster than European yields and Chinese yields. So on a relative basis, US yields will go up more than everybody else. But there is a beta to the US. If US yields go up, it's very hard for other countries' yields to go down. So in general, I think we're in a still rising bond yield environment. That's number one. Number two, I think that the dollar will be strong. against almost all currencies, because there's a relative story here now that the level of US yields are so high now that by itself that's attractive. Then on top of that, you overlay the fact that US growth is probably the strongest relative to other countries in the world. Every other country has a growth problem. So I think we're going to see a lot of dollar strength. So euro could go down towards parity, maybe lower. Dollar China could go to 640, 650 perhaps. So we'll see general dollar strength across the board. Then on equities, like global equities and US equities, I think we're going to have a more difficult environment for equities, because if yields are going up, I think that's a challenging environment for equities in general.
And what's your thought around? Okay, I'll come to India, but let me just kind of link it to the point that you just now made about the global yields. You know that India has now been included in at least one of the global JP Morgan bond indices. If you ask any Indian fixed income trader, he'll tell you this is something that we've been waiting for last 10 years. Now that it has finally happened, the markets have been relatively calm about it, right? And given the context that you've kind of set out, which is to say that global bond yields are headed higher, probably led by US, and that makes the attractiveness of EM markets less, EM markets sort of less attractive for the global fixed income investors. What's your take on this bond inclusion story? Do you think that despite a tougher global environment, we will benefit from flows? Or, I mean, in some senses, they're index flows. They will have to come. At least the markets locally are assuming that they will have to come. But what's your sense around this?
Yeah. I mean, I think this is very significant. I also think that if you look at the JP Morgan government bond index, what happened was that they dropped Russia, obviously after the Russia-Ukraine war. And so the overall yield of the index had gone down. And now with India coming into the index, it pushes the yield back up. So that's also an interesting that Russia coming out, India coming in makes it even more attractive for the flows into the index as a whole in terms of new money coming in as well as passive switching. We estimate that we're likely to see around $30 to $40 billion of flows into the bond into Indian bonds because of the index over the next 12 months. That's quite a large flow. So that in general should help Indian bonds. So on a relative basis, in our view, Indian bonds should trade better than other emerging markets because India is the one with this very supportive bond inflow. So my sense is that on a relative basis, this bond flow story is important. It's large and it will help India relative to other countries. By itself, though, if US yields are going up, it's hard for Indian yields to go down. Even with this type of flow, there is a beta that you can't ignore. So I think Indian yields will still go up, but perhaps not as much as other countries because of this flow.
And what's your view on India macro? I think we've kind of, in some senses, have been the fastest growing economy now for a while, right? Given the fact that Chinese growth is slower. We've also seen Indian inflation reasonably well behaved, I would say. I mean, we've had a recent, food price shock, which kind of pushed inflation higher, but that's kind of unwound quite quickly, and government has taken some steps to do that. So we seem to be in this kind of Goldilocks scenario where inflation is steadily coming down. Growth seems to be fairly well supported. Global flows continue to be there, and India's external balances continue to be fairly robust. Our current account deficit this year is likely to be less than 2%. So in that context, how do you see India macro play out, particularly if US rates continue to be higher?
Yeah, I mean, I think in general, the Indian story has been really, really positive. Growth has been very sort of solid, and I think will continue to be relatively strong as well. So on an absolute basis, growth has been quite high. And compared to other emerging markets, comparable countries, Indian growth has been very strong. And as you rightly point out, inflation has generally been heading lower, core inflation as well. So the macro story is very strong, and I think it will continue to be strong. My biggest concern is not so much US yields, because India is a relatively kind of closed economy in some ways, so it gets less affected sometimes by the US dynamics. From an economic perspective, at least, the biggest issue is really commodity prices. This food price increase, will it continue or not? Oil prices, are moving higher, and some of the discounts that India was getting from Russia are rolling off as well. So for me, the commodity cycle is perhaps the thing that could really impact India in a negative way. So for me, that's the thing I'm watching for. And I think that's the biggest risk for India, and especially food prices, because as you know, when food prices go up, that really impacts the average household. People, do look at that as their kind of main source of prices. And so that affects consumption and people start to step back if that was to happen.
Do you have any view on rupee?
Yeah, on the rupee, I think overall it's been relatively stable, but my bias is that I think the dollar India could go up towards maybe 84, 85, so slight weakness in the currency. And that's more driven by the fact that we're seeing a lot of dollar strength at the moment. And I think that this rise in oil, I think should see some weakness in the currency. So I think we see some moderate, weakness in the currency, but not necessarily significant weakness. And of course, you have the central bank that often stabilizes the currency as well.
Yeah, no, that's been a great conversation, Bilal. I realize that we're reaching at the end of our 40 minutes. That's the allotted time that we have before we pause and take a few questions from the audience. So let me hand it back to Tanay to take a few questions from the audience.
Thanks, Neeraj. Our first question is from Nitin Parikh of Hindalco, and you just spoke about commodities, so it's an apt question. Is the commodity cycle dead? With Chinese strategic patience, slow growth, move away from the manufacture and export model, elsewhere there's weak demand as well coming in. Metals are very weak. So is that going to come up at any point, and how will metals recover? And with that, how do you see crude oil behaving as well?
Yeah, sure. I do think that the commodity cycle is still alive. And I think that what we've seen in oil so far this year tells you that, that there's something significant going on in oil markets where we're starting to see Brent head towards, $100. And why is that? Why is Brent heading towards $100? Part of it is that the US economy is doing very well, even when China's weak. So this tells you that China is not the only source of demand for at least oil. There's the US as well. But also the supply side, I think, is a big story. Russia is basically not producing as much. Saudi is cutting oil and trying to manage oil prices at a high level. Also, you've had some natural disasters in North Africa and Libya in particular, which has taken some oil off the market. So my sense is that at least the energy market is still in play. And I think that that cycle still exists. And we could see some major and big moves in energy prices. On the metal side, I think that the iron ore prices, I think is the one which is less clear because of China. China is the biggest source of demand for iron ore, and it's linked to infrastructure and so on. And as I said earlier, I don't think that's going to be very active. So iron ore could struggle to have a meaningful move. Copper, on the other hand, I think could see a large structural move over time because it's very much linked to the electrification of cars. Copper is used as an input into that process. So overall, I think that the commodity cycle is still alive and kicking, even without China sort of demand. I would say that energy and copper in particular, ones that could see the largest appreciations. Iron ore, I think, is probably the one that gets affected by China and could see less moves over the medium term.
Bilal, I'm very curious to know what your views on oil politics are. I mean, given the fact that Saudis are kind of unilaterally cutting the prices, there is this pending demand from SPDR that US has to do. I mean, I think they were supposed to come in at 70, but they didn't. And now we are at 95. So will they come in at this level? And their ability to actually use those reserves to kind of dampen the impact of higher oil prices, or at least manage the supply demand situation a bit better, is kind of weakened, right?
Yeah.
So does it mean that we see like 120 on oil? I mean, where do you think it's headed?
Yeah, it's a good question. I mean, in terms of the geopolitics, I think Saudi is really critical in all of this. And I think that one thing we underestimate with Saudi is the amount of domestic spending they're doing in terms of infrastructure programs, building new cities, buying football players from Europe. I mean, these are large numbers. And so to some extent, they're trying to maximize their revenue. And I think their spending program is just phenomenal. And so they have to raise money for that. So I think the politics there is about Saudi just trying to get as much as they can, knowing that the Western countries can't get oil from, say, Russia, for example. So I think that keeps a certain lower limit on oil. And as you say, the reserves that the US has are very low. If anything, they should be buying, not selling. So I think US can't control the oil price here. My sense is I think we're likely to go to $100, maybe higher, maybe 105. 120 right now is a bit harder to see. I think to get to 120, we do need to see some demand from China. I think you need some like meaningful additional demand kicking in. So for 120, you need China to be active, which I don't see at the moment, given the conversation that we had. But I think certainly 100 is definitely within reach.
We're almost there, actually.
Yeah.
Away. So yeah, Tanay, you can go on to the next question.
There was a second part of the same question which I didn't say out, but. What if Trump wins? Do we see the US-Saudi relationship once again picking up and therefore oil politics changing?
Yeah, that's a good question. I think to some extent, some of the supposed improvement in US-Saudi relations was a bit overstated. That I think Trump claimed a lot of credit for things that wasn't entirely due to him. I think also the Saudis made an effort to, cater to Trump's vanity. So, for example, if you look at the relations with Biden since Trump, the US-Saudi relations haven't been too different. If you look at the trade between the two countries, financial flows between the two countries, it's similar to what we saw under Trump. So I don't think if Trump was to come in, we'd see anything too different with Saudi.
Thanks for that. Okay. Our next question is from Manish Shah, who is the CFO of GHCL. Where do you see the USD going ahead? We had a peak earlier in the year with euro below par, but are we seeing a new one coming? Especially if what you're saying about the ECB cutting rates and the Fed raising them is true. And what about the yen? If the Fed keeps raising rates, what happens? Does the MOF intervene aggressively? Is the BOJ forced to raise rates?
Yeah, on the euro, I think that we are going back to parity. So that's where I would see us going. We could even go lower, maybe. I mean, the low a year ago was around 95, 96. So that could also be possible as well. But my base case is that we head down towards 1 or parity. So I think that's where we're likely to head. On dollar yen, I think 150 is within reach. We're close to that already. I think if we do go above 150, then we will see some kind of intervention by the Japanese. It will start with verbal intervention, which they tried a month or so ago. Then it will be actual intervention. On the BOJ side, I don't think they will actually raise interest rates, but they will talk about raising interest rates. So I think what you'll end up seeing is, verbal BOJ kind of intervention, so to speak, an actual currency intervention if we were to go above 150.
And Bilal, on this BOJ point, I mean, I think when there was this change of the central bank governor, and he indeed did some tweaks in the YCC, initially we didn't see the bond yields actually go towards the YCC cap, right? Which was, I think, it's 75 basis points or 50 basis points.
Initially it was 50. Now it's 1 now. Yeah.
Now it's 1, right? So again, given the fact that US yields are likely to stay higher or inch higher, this will put a lot of pressure, right? If they don't tweak the YCC again, they will continue to see enormous amount of pressure on yen, right? And how much ammunition the MOF has to intervene, not very clear, right? So where do you see the breaking point in this equation?
Yeah, it's a great point. And I think that if you look at the yen against other currencies as well, like euro yen and other currencies, the yen's weakened also against the euro and other currencies. So it's been, outright yen weakness this year. And so the question then for the Japanese would be, how important is a strong currency versus how important is getting wages higher in Japan? Because the reason the Bank of Japan hasn't raised interest rates so far is that they want wages to go up a lot. That's what's holding them back. At least that's what they're saying. So my sense is that in the end, they'll probably accept a higher dollar yen. rather than compromising the possibility of getting higher wages. The real test then, the breaking point, I think, would be at 155. If we were to get to 155, that will be the real test for them to see whether they'd allow a real overshoot to happen. So that's what I think the threshold would be.
Yeah.
Okay. Our next question is from Afroz Derki, who is VP Finance of Matrix Partners. He asks, we're now in the QT era, and there were many people who said QT wasn't possible and can't continue and so on, but here we are, and it's a departure from QE. QE began more than 10 years ago, and no one remembers what life was like before that. How will markets behave now with QT?
Yeah. I mean, I think on the QT side, what we've seen is that we've seen kind of passive QT, where what the Fed has done is, as bonds mature, they don't reinvest, and so the balance sheet is naturally just shrinking. What they haven't done is that the mortgages they hold, they haven't sold those mortgages because nobody's prepaying their mortgages. So the mortgages aren't rolling off because nobody wants to prepay their mortgage, which would force a redemption. So for me, the interesting thing to watch is if they decide that they have too many mortgages in their portfolio because the treasuries are rolling off, then they have to suddenly start to sell mortgages. And then that would force mortgage rates to shoot higher. And then that could end up having a big impact on housing within the US and then the economy as a whole. So for me, the type of QT is important. The treasury side, I think, is a non-event. It's just kind of happening passively. It's what they do with mortgages that's really, really important, because already mortgage rates are going up. If we suddenly get a signal from the Fed that they have to rebalance their balance sheet because they've got too many mortgages, and then have to start to sell those mortgages, then mortgage rates will go up even more. And that will be effectively like a form of tightening that they're doing. So that's the thing I'm watching at the moment, which they haven't done so far.
One from Srinivas Singaraju of Coromandel. He asks, based on your discussion with policymakers and everyone, where do you stand on the eventual revision of the inflation target? Because if what we're saying is right, inflation is going to be very difficult to bring down, and as a consequence, you can't grow economically and maybe even compete geopolitically. So are we going to see that?
Yeah, I mean, I was recently speaking to one or two people who attended the Jackson Hole conference in the US, where all the big central bankers attend. And apparently there were some conversations, over coffee about the inflation target. But the clear consensus, they will not change the inflation target, because the fear would be that would give a signal to the world or to the economy and markets that they're no longer credible. And so far, the inflation target has worked, because if you look at people's expectations of inflation for the next few years, it's around 2%. So them having the 2% target, even though inflation has ended up being higher, people still believe inflation always is going to go back to 2%. So if you look at the inflation bond market, everything keeps going back to 2%. If you look at surveys of economists, everyone keeps thinking it will go back to 2%. So it's working in the sense that it's anchoring expectations. So my sense is that they won't revise the target, because it's working in the sense that it's anchoring expectations. So I think for now they'll keep it, and they, in some ways, they've got the best scenario right now, which is that inflation expectations are anchored at 2. Inflation ends up being higher, and that allows debt to go down in real terms. So this is a win-win for a government, because the people who hold your bond get unexpected inflation, which reduces the debt for the government. Yet people still think inflation will be low, so they carry on buying new bonds. So this current environment actually works quite well for policymakers.
Yeah, but it sounds great, but I think there are downsides to this, right? I mean, you can't continue with this environment for a long period of time, because at some point in time, the rational expectations, some senses, will kick in, and people will realize that they're getting effectively fleeced, and that'll force them to dump the long bonds, right? So, which is, I don't know if that's what is starting to happen in US now. But I was curious to know, Bilal, if you, in your modeling, when does US inflation get to 2%?
Yeah, in our modeling, it gets down to 2%, not next year, but in 2025. So we think next year inflation will be around 3.5%, 4%, and that the Fed will have to start to increase interest rates. And then by the year after, that will be enough to start to bring everything back down towards 2%. So yeah.
Yeah, so you do see a clear path to 2% with this setup, in the sense that even though the labor market is strong, the wages have not really come off, the unemployment numbers continue to be low. And despite of that, we will see this disinflation process continuing to bring inflation down. So the market will start getting to see that visibility of inflation coming down to 2%, right?
Yeah, but at the same, it will still require the Fed to raise rates further. That's the important caveat. If the Fed just doesn't raise rates further, we'll have a problem.
Oh, so you in your modeling, therefore, you're expecting that the rates go up further from here, and that's the one that kind of brings down.
Yeah, exactly. Yeah.
Okay, that's interesting.
We have one more question on fiscal. Now, fiscal used to be a dirty word for quite some time, but after COVID, everyone appears to be okay using it. And you mentioned fiscal worries are once again returning. What sort of fiscal targets or what sort of ideas do you expect to work out in the fiscal front going ahead, and how would that sort of impact growth, inflation rates, etc.?
Yeah, I mean, I think that one of the things policymakers learned from the global financial crisis was that austerity doesn't work. After the GFC, all the countries basically said we want to have austerity, and the problem then was you had long economic weakness for a long time. Now COVID hit, and they realized actually we need to do stimulus, and perhaps they did too much because we ended up with too much of a boom. But now I think countries are much more willing to use fiscal stimulus. That said, we've had a lot already. Debt levels are high, so now each country is now interacting or thinking about fiscal stimulus in different ways. So in the US, the fundamental issue is that you have a divided Congress. So it's less about the philosophy of fiscal stimulus. I think it's more to do with the fact that you have a divided Congress. So that's always will be the limit to how much stimulus you can have. So that's a political issue rather than an ideological issue. They'll do stimulus. If the Republicans come in, they'll do stimulus. If the Democrats have full control, they'll do stimulus. That's, I think, a given now on the US side. On the European side, it's a bit different. Say Euro area, I think, is willing to do stimulus if it's linked to structural changes. So, for example, if it's linked to energy transition, they're willing to do some stimulus. But what's interesting is if you look at the conversations in Germany, the conversation is going more towards austerity, where they're not willing to do any stimulus. So it seems like Europe is kind of moving away from stimulus. And then you have China, which is willing to do stimulus, Japan, again, which is willing to do stimulus. So I think there's been a shift in mindset, but I think in some cases we're kind of reverting back towards the old ways, especially in Europe.
But Bilal, I take your point that US is fundamentally, political standpoint, more inclined to give stimulus, right? I think whichever party comes, they will be more inclined to give stimulus. But given the fact that the debt to GDP ratio is now, I think, is close to 100%.
Yeah.
I mean, US used to be quite low, right? And they're reaching that so-called magical number of 100%. And the fact that, I mean, probably they can do that because dollar is the reserve currency. But what is the theoretical limit here? I mean, I'm sure they can't just keep on doing this, right? At what point in time?
Yeah. No, it's a good question. I mean, I did a study once going back, 500 years to see like when do you lose sustainability, and it's less to do with the level of debt. So it's not to do with like 100% or 200%. It's more to do with whether you have a combination of worsening fiscal deficit, worsening current account deficit, and inflation picking up. So if the direction of travel on all three are bad, you end up with a fiscal crisis. So for me, the thing I'd look at for the US is if they do stimulus, presumably the fiscal deficit will be getting worse. So that's tick number one. Is the current account worsening? At the moment, it's improving, but if it worsens, that's tick number two. And if inflation currently it's falling, but if it picks up again, then you have a problem. So I think if all of those come into place, then you have a crisis type dynamic kicking in. This happens a lot with emerging market countries very quickly. In the case of the US, because of its dollar as reserve currency, they have a bit more time on their hands. But even the US can't escape that dynamic in the end.
Yeah, I think that's interesting. Tanay, are we done with the questions?
One more, and we have half a minute more, so let me just go into it. One from Devendra Kumar from IDBI. What's your target for the 10-year benchmark treasury yield?
So my target is around 5% for the Treasury. So I think we'll probably get there in the next 6 to 12 months.
Thanks. That broadly covers all the questions.
Yeah. Before we wind down, Bilal, I want to ask you one last question, and this is the question that you ask your guests at your podcast. What is the best way to follow you? What's the best way to keep up with your research?
Oh, great. No, great question. Yeah. If you just go to macrohive.com, you can sign up for our free newsletter. And then also I'm on Twitter as well, just Bilal Hafeez 123. You can follow me on Twitter or X, I guess you can call it that, or I'm on LinkedIn as well. If you just search Bilal Hafeez, I'm on LinkedIn there as well.
Thank you so much. It was wonderful having you, Bilal. This conversation was absolutely amazing. Wide sweep, looking at the global macro and markets. We'll look forward to having you more often on our webinars. So with that, thanks a lot for joining us today.
Thank you for the kind invitation.
Thank you very much, Bilal and Neeraj. On behalf of Axis Bank, this concludes the discussion. I would like to take a moment to convey our gratitude to our speakers, to our clients for the time and the benefit of their experiences. We look forward to our customers joining us soon for the next edition of Treasury Market Talks. A recording of this discussion will be available in case you wish to have this passed on to your colleagues. Do connect with your relationship managers for help. Once again, thank you for joining us. You may now log out from the webinar.